Hey, what's up guys? It's your boy 007 here on a Saturday to do another review on the market. So last time we did a review was about 2 weeks ago. Last week we were really busy with a lot of things, so I didn't have a chance to take a look at the market, but it was a short week too, so I didn't expect market to do much. There wasn't much like catalyst or any news that made it look like there was going to be anything interesting, so it wasn't really worth that much of a review. But we kind of covered the last time on SPY. We said that we held that 370 level over here and we would cover back up. So I said to start taking some profit and deleveraging a little bit as we made that run back up. That kind of held true. So now looking at SPY again, it looks like the it looks like the money flow right here, the money flow is leaving the market. So that means people are selling off and the RSI is crossing over to the downside, which is usually a sign of bearishness. When we ran so far up, we were up for like 10-11 days straight, so it was only natural for us to pull back a little bit, because we can't run up forever, right? That would be unfair. Who would buy the dip? Like how would we get opportunity to buy the dip if the market just keep going up? So that pulled back a little bit. But on Friday we closed with a doji, so it's really, we could really go either direction. But as far as the signal right now is showing a little bit bearishness, and if we could move back to that 377 levels over here, but we'll really see. It's hard to say because on Friday there was also over $1 billion of balance on the buy side too, so there was a lot more buying on Friday than selling. So unless something crazy happens over the weekend, we'll probably most likely either go back up or remain neutral. So let's check out the Q sector. Last time we looked at the Q sector, we said they had the tech sector, they had great ERs back to back. Almost every stock performed extremely well in earnings reports, but they pulled back because they have been running non-stop. And that's true. That's why a lot of the stocks kind of chop. Look at Apple, look at Amazon, those big earnings reports, they slowed. They were great, but they didn't run anymore because it was already expected. All the stocks already ran like crazy, so it was only natural. It was kind of weak. It didn't move much. The QQQ sector just kind of been choppy, and they're showing the weakest strength right now. So this also looked weak as well. If we break under this $327 level, we'll probably go all the way back down to 318, which would be like almost like a $9 drop. But the bullish case for them is that they have been chopping for a while, and all the text ER was extremely bullish. They were the only ones that could really justify the fact that they had a good run, or that why the market should be bullish on them. And then let's take a look at the financial sector, the XOF. Last time we did the video, I wrote we held that $29 level over here, and we could move back up and break above the all-time high for the financial sector. Look for plays in Bank of America, Goldman Sachs, JP Morgan, and Prudentials. So that's exactly what happened. We held that level, we moved all the way back up. We had this this triple top line here, and dated back to pre-COVID levels, and we broke it. We broke above it, so that was the all-time high I was talking about. That was 3160. So we broke above it. Financial sector has been performing extremely well. Nearly every single financial stock has been having the best 2 weeks ever. So it didn't go down. It was just either up or just kind of choppy a little bit, but it was mostly up. So I would expect for this sectors to cool off a tiny bit, maybe come back. Right now it's trading around 32.40. The sector is probably gonna come back to test that 31.60 a little bit before it makes another run back further to catch up to all the other sectors, because this sector compared to last year is only up like 5%, whereas every single other sector is up like 15 to 40%, even small caps. So this sector needs a little bit catching up to do. Financial sector is usually more stable and safe, so it usually moves a little bit slower. But with all the other sector running like crazy, I wouldn't be surprised to see this catch up. So this has definitely been a safe place for me. If I think the market is gonna go down, I usually try to park some money here, because I know they move so slow. I would have time to get out and exit if I need to be. And then lastly, we're gonna take a look at let me update this note for financial sector. So lastly, we're gonna take a look at the dollar index, which for like the last 10-12 months has been, you know, really good to help by helping me predict the market. But I don't know what happened, man. Like 2 weeks ago, it's as if like, you know, as if like the big Wall Street funds or something started watching the videos or something, and they found out that everybody's been looking at the dollar index, and now they're just sending mixed signals on the dollar index, you know, just kind of messing with everybody. Like what used to work so perfectly as an indicator to see how the market was going to perform didn't work anymore, you know, for us on the dollar index. So that was really weird. But last time we looked at it, I said look for the dollar index to eject that 9180 area, and for possibly start hedging for the stock market as we get near this level, you know, and buying some VIX and UVXY shares. But even the VIX and UVXY shares, they didn't work that well for us as well. You know, as we got close to the level, I started to pick up VIX and UVXY, but even with those, they started dropping a lot because the market was hitting all-time highs. You know, we had all-time highs earlier this week on like Tuesday or Wednesday, and the market just kind of came back from that, right? So because of that, the VIX and the UVXY shares went back down. But that's something I'm gonna probably hold for long term, just in case like the market actually crashes, something crazy, you know, out of the ordinary crash like COVID, and that will end up paying up, because VIX and UVXY will go up 10 times if something crazy happens. So that's something that I'll still hold on to. But as of right now, what we see on the dollar index is that it's forming kind of like a head and shoulder. So this is the shoulder right here, this is the head, and this is the other shoulder. So usually a head and shoulder pattern means that it's really bearish. And so this is the head and shoulder pattern. It will go like this, and then this, right? So if that pattern plays out, that means the dollar is going downhill as we expected this whole time. Because if stimulus comes out, obviously the dollar and the inflation is gonna come, right? Inflation comes, the dollar is gonna get weakened, and it's gonna go downhill. If the dollar goes downhill, that means assets would have more value, thus the stock market, right? So that's why it's good for the stock market if the dollar goes down. That's why I wrote it here: dollar up equal market down. If dollar is down equals market up. So that's what our thoughts on the dollar index is. And then lastly, the other thing that could possibly impact the market is also crude oil futures. So typically when oil futures, you know, run up, market is usually pretty bullish. But when oil futures start coming back down, that could be bearish for the market as well. You know, you kind of see it here as well. Back in like, you know, January of 2020, you know, you saw like weeks and weeks of oil futures start going down, right? And this was before market even crashed. So this was like about a whole month of oil futures just going down, because there was less demands, you know, as globally, especially from China at that time. So because of that, because less economic demands, that caused the oil futures go down, and that's what, you know, really kind of caused gave us the early signal in the market crash. And as you can see, like oil futures crashed some more. So there's always going to be something interesting to watch, to really see like where it's going and monitor it closely. Because if this start going downhill a lot, man, we got to start getting worried, you know. And then lastly, going over some things that could affect the market. Some of the news that we saw that we think could affect the market was that the Federal Reserve recently warned that there was significant risk of business bankruptcies and steep drops in commercial real estate prices. So usually when something like that happens, that really means, so let me find the article. So this article that we found, they said, due to COVID, we're finally starting to see like a lot of bankruptcies and real estate price drops, and because of the forced close down, the quarantines, all that stuff, we're finally starting to see the after effects of COVID, and this after effect was something that pretty much everybody that was bearish from last year was anticipating, for forever, right? Everybody from last April to June was anticipating that, the market wasn't going to go up so much, because we knew fundamentally for a fact that, business were going to go bankrupt. We knew for a fact that demand was still going to be slow, and commercial real estate wasn't going to go anywhere, because who's going to get into commercial real estate if the whole market is, if nobody is like doing business well enough, and we're getting into quarantines and things like that, right? But for some reason the market didn't care, didn't give a crap about that, and the market just kept running up. So that's definitely something that's on the radar that could be troublesome. So we have to kind of stay hedged and just be ready in case that becomes the next catalyst for a big drop in the market. And maybe they'll call it the after effect of COVID. Who knows? But that's definitely a possibility there. Not to be like a big bear about it and stuff. The other thing was that this week we saw a lot of crazy news about Texas and their snowstorm, from that. I remember on Tuesday or Monday, we saw that crazy truck accident, where trucks were just piling into another truck and another truck, because, this is the South. They never really had snow like that or icy roads like that. So they weren't prepared to deal with, the snowstorm and the aftermath of the snowstorm. It was crazy. Snows are piling on top of people's houses, and there were like, roof collapse, everything, pipe bursts everywhere. Generators weren't operating well enough because of the freezing temperatures. Nothing was working for them. The power grid went down. So it was a huge energy nightmare. Pipelines got shut down for oil as well. So that could also actually cause an oil squeeze upwards again, actually. But who knows? I mean, it actually did cause a squeeze already. Maybe that's the end of the squeeze. Not sure. But they're estimating that could cost as much as $50 billion in damage. Like, we're not even talking about millions. We're talking about $1 billion in damage and economic loss because of that whole 1 week of like huge shutdown and everything. Like, people are talking about possible like some people could see like $10,000 plus in electric bills, because they were using space heaters all week and everything, man. It's nuts. But that's some of the bearish stuff, possibilities and things like that. Let me give you guys the bullish news, so this way we don't get all depressed and start shorting the market, right? So the bullish news is that Pfizer, they said they could double their vaccine production, and distribution could increase if the FDA allows them to store their vaccine in the pharmacy fridge instead of like special freezers and stuff. So if both of those things happen, if they double the production, which they're trying to apparently, and if the FDA rule in their favor to let them put their vaccine at the pharmacy fridges instead of special freezers, then distribution process can go really well. But the other thing that's also slowing down distribution of the vaccine is also the snow, this whole winter situation and whatnot too. That's been creating a big backlog of like vaccine distribution. So that's also another huge issue in the way, because we can only carry so much and distribute so much. There's only so much area to hold in stuff. It's a whole new thing we're not ready for, But the bullish out of all these news is probably the US House. They plan to vote on. So US House plans to vote on Biden's 1.9 trillion rescue package on February 26th. And they wanted to get the plan in place by March 14. The reason behind that is March 14 is when the pandemic 8 expires, so they want to get it in before that, so this way we don't have like we don't have a delay in between. So if that happens, that's going to be pretty bullish for the market. So hopefully we get that, so that the market can continue to run higher, and all our stocks go to the moon. But this is definitely starting to get to the point where we need to be careful, because the market has ran so much, and we haven't had we haven't seen the effect of the recovery yet. We're still like a year away. They say we could still be locked down until late September or November, before 70% of the population gets the vaccine, are vaccinated. So that's that whole situation, man. We still got a long time to go before the market, before everything goes back to normal. But obviously the market is still like, the market has recovered tremendously. The market has ran up all-time high when we're still dealing with so many situations right now. So that's gonna be something that iffy that we're looking at. So for next week, we're looking to look at some value trades instead of chasing a lot of these like big tech names. I mean, I'm still gonna invest in Apple because I still like Apple, but I'm gonna look forward to more of these value trades, so that if everything collapses, at least we won't get hit that bad. So one of the value trade I'm looking at is Barrick Gold Corporations. I'm not sure if it hit this level, but if it does, this is an opportunity I'm looking at. If gold comes back down to this 1870 level, we'll look for that bounce to possibly come back to $22 at least, because fundamentally the price of gold should continue to stay high. And even though this is a gold miner, they should continue to make better money from it when everything reopens and stuff like that. So that's a possible opportunity there. Another opportunity we're looking at is let's see what I got right there. MKC McCormick. They're like a spice company. They're more of a consumer staples company. So by consumer staples, it's something that is always going to do well, even in terms of a depression or recession. So this is another stock that I'm looking at. They had pretty good earnings report last time. They're a dividend company. It's usually typically a slow mover, as you can see here. Very slow. It doesn't move much generally, but I think if we come back down, to this level, this is creating a pretty interesting value opportunity, being that this is the same level that it was before the COVID crash, right? And being a company in their situation, they actually aren't affected by COVID, because people are still buying spices and all these other miscellaneous products they sell during COVID times. So they're still making money, if not even more money. So we're expecting them to bounce off this level at $84 range and come back to at least $91. So those are the two trades I'm looking for in terms of value opportunity. And that's pretty much it. I hope that helped you guys out. And if you guys like the video, don't forget to like and subscribe and give us a thumbs up so I can keep doing them for you. But other than that, have a great weekend, and we hope to see you guys next week. Take care.